You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of The Options Playbook. All right, so this week we're going to actually follow some unusual activity that just happened to occur in United Airlines. So the airlines are kind of bouncing back. I shouldn't say kind of, they are bouncing back ever since the pandemic and the vaccines have been announced. And as we're slowly digging out of this pandemic, because of the vaccinations, we're getting more and more good news about the number of people that are vaccinated overall. We're seeing a little bit of a bump up in the airlines. And so we did see a fairly large trade in United this week. On Monday, we actually saw the April 1st, that's April 1st, it's not April Fool's Day, it's April Fool's Day, but this is when the expiration for that trade occurred. 14,722 call options actually trade at around 85 cents. So it kind of looks like it went off close to the asking price on that day. The open interest was only 122. So odds are that it was a buy, implying that the person that was speculating on that trade with about $1.5 million was hoping that the underlying would get above 70 by that expiration date. Now, the volume has kind of changed hands. The market has been down. UAL today is actually up quite a bit. It's trading at $62.45. It's up $2.64. And I should let you know that we are taping Options Playbook Radio on March 17th. It is St. Patty's Day. The rivers are green in Chicago. They are usually green from the days that I lived there, but for some reason they like to highlight it and put some type of dye in that makes them a little bit more green over St. Patty's Day. But with that said, the markets are closed here, and that trade that we noticed, we are going to try to piggyback on. Now, I'm looking at some of the volume today, and it looks like a lot of the open interest has came out of United Airlines, in particular on that 70 strike call option. So there has been trading that has been out of it. But with that said, I think it makes a great paper trade. And as always on Options Playbook Radio, we're not meant to be recommendations. We're just going to look at paper trades. That person was thinking that the underlying stock by April 1st could be out of, be above 70, or ideally you wouldn't buy that call option. It doesn't make any sense to buy that 70 strike call. You're going to be battling things like implied volatility moves and time decay. So ideally, if you're going to be buying that option contract in such the short term move, you're really going to be thinking the underlying is going to get above 70. And you needed to go a good bit above 70 to really make that trade profitable. So the way that I would approach it if I saw that underlying trade and I wanted to piggyback on it is what we're going to talk about today. But before I get there, let's just recap what we looked at last week. We were looking at Johnson & Johnson. We built it as a FOMO trade, which means a fear of missing out. And a lot of that has to do with exactly where we are in the dig out from the pandemic. Johnson & Johnson is one of the pharmaceutical companies that actually did come up with a vaccine. They actually have the one-shot vaccine as opposed to two shots where most of them are at. And we thought maybe going into the summer month, it might be a more popular vaccine overall, especially considering that these vaccines have to go all the way across the world. So what did we do? We went out to June. We bought an in-the-money call option. We actually bought the 145 strike call. It had around an 80 delta, and that was our goal. We wanted something that was going to act a little bit like the stock. And when we placed that trade, we paid right around $17 for it. The market was open. It was last Wednesday. And right now, we see that Johnson & Johnson today, with the markets closed at 160.77. It's down 60 cents on the day. And that option contract is trading on the bid at 17.30, on the ask of 17.65. So you're up a few pennies on that. Let's call it 40 cents if you could get a fill somewhere by that midpoint. But the concept was that we were going to stay the course in it. It's a fear of missing out. We want to see what happens as we get into the summer months and see how the economy does, how the distribution process works, and see where we are at. And so in this instance, we use the option contract to limit our risk, but still give us some upside potential. So stay the course would be the recommendation on the paper trade from last week in Johnson & Johnson. And let's go back and look at exactly how we would follow the money in the United Airlines unusual activity that we saw on Monday afternoon in United Airlines. All right, so if I were to do this trade, I think saying that the underlying stock is going to get somewhere near that 70 level at that point in time, the market that would mean that it was looking for about an 8 or 9% move to the upside by April 1st. So that's a fairly hefty move. I wouldn't really feel too comfortable with that. But what I would do in that situation, one of the things that is really good about that 70 strike call is that it's going to be really liquid. There's a lot of open interest that was created by that trade. So I'm going to sell that call option. I'm going to say, okay, well, if you're right, you can have the gains above 70, whoever made that big trade. I don't know exactly who he or she was, but in that instance, if you're right, that's okay with me. I just want to take my little nugget and I want to run. So I'm going to actually do a long call spread. And we're going to have to do that today. The markets are closed and the stock is up a little bit. That call option on that trade is trading fairly close to where that trade was executed at. I think it's right now, if I take a quick peek at it, I see that the asking price is right around 90 cents. So even that would even be a small profit, but on that many contracts, that would actually be a fairly decent size profit overall if they were to be able to get out at 90 cents. But the volume and open interest have been heavy over the last couple of days. And right now we see that open interest right around 10,000 contracts, which means there has been some liquidation on that trade, but there's still seems to be quite a few shares out there. But now it's getting a little bit convoluted. It's hard to tell exactly how much of that open interest is from that initial buy that happened on that Monday. And we're assuming that it was a buy to open. There's no guarantee of that. It's just from looking at how the volume worked out, an educated guess would be that they came into the marketplace and bought that option contract that many times. All right. So here's the trade. We're going to stay in the same expiration. We're going to kind of play off that 70 call, and we're going to go out and buy the 65 strike call. April 1st expiration, and at the same time sell the 70 strike call, which is also known as a long call spread, a vertical spread, a debit spread. Bottom line is the market's at 62.45. You're still looking for a very strong move up to 70 before that April 1st expiration date. But we're able to do that trade for close to a net debit of 108. That's where the midpoint is at right now. That means for every 1-by-1 spread, we're going to have $108 plus commission of risk. Now, it's a 5-point wide spread, so we're still giving ourselves quite a bit of upside. And we're going to say, well, if it goes above 70, that's okay. We're going to take our ball and go home. We don't get to play anymore. But that will give us $3.92 worth of upside. We're giving 2 weeks for this trade to play out, and that kind of fits it right into a long call spread. Because if you're correct on your forecast on a long call spread, you want to be correct closer to that expiration date. So if the move does happen and it happens closer to that expiration, you have a chance of making the maximum on this trade, which would be $5 minus the 108 or $3.92. Now, remember, you got to take commissions out of that whenever you're doing your option trade, or that would be $392 less commission. And your total risk would be the 108, which is $108 plus commission on that trade overall. So piggybacking on that trade, I think it was pretty aggressive. Obviously, it was very aggressive to think that you would buy an option outright on that 70 strike, anticipating that UAL would go up approximately, we'll call it 10%, because that's really the type of move that you needed to make that trade really profitable overall. But you have a lot of them. So even a dime or 15 cents would be a very profitable trade on that underlying. UAL did go down the next day, but it is up strong today. All right. So that's going to be it for this episode of Options Playbook Radio. The trade for this week, I'll review it real quick, in that we are taping Options Playbook Radio on March 17th. It is St. Paddy's Day, and the markets are closed. United Airlines last traded at 62.45. It's up $2.64 on the day. We are going out to the April 1st expiration and doing a very speculative paper trade this week, not meant to be a recommendation. We're going to buy the April 65 call and at the same time sell the April 70 call. The midpoint is a net debit of 108. That's $108 plus commission, and that would be your max risk on your trade. All right, everybody, enjoy your St. Paddy's Day weekend. Let's hope the Chicago River stays green for all of you that are listening to it in Chicagoland, the home of Options Insider Radio. And I will be back at the same time, same place next week. If you'd like to get a hold of me before next week, you have a topic you'd like to discuss on the show or a question you'd like to ask me on the program, you can send them directly to me at theoptionsguy@invest.ally.com. You can also follow me on Twitter. My handle is very simple. It's at Brian Overby. Thanks for listening, and we'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money, and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.